Howdy, Jacob here. Today we're looking at Takeda Pharmaceutical, ticker symbol TAK. Get into some of the financials here. We have a $46.8 billion market cap on $74.3 billion enterprise value. It's in the pharmaceuticals industry. Again, it's so interesting to see companies you never heard of that are as big as this. 4.2% dividend yield, and return on invested capital, very low single digits, probably averaging about 3%. So it definitely makes sense that they're giving money back to the shareholders through dividends. We are seeing gross margins down slightly from 71% to 69%, but operating margins have gone up from 8.2% to consistently the last 3 years, low double digits. So that's great to see. Let's look at some of that debt though. We do have almost 30 billion in net debt here. Cash equivalents with short term, we're looking at just over 4 billion, maybe 4.1 billion on 2.5 billion short term debt and 30.2 billion long term debt. Okay. Cash from operations, okay, jumped up huge in 2020. Looks like two devastation years, and their free cash flow is hugely higher after a huge investment in 2019. That's interesting. And so, 5 year average, again, you have something as high as eight and as something as high as like 8.7 billion and as low as 2.5, probably averages out to roughly $6 billion. That dividend payout of aggregate payout of 2 billion is about 30 to 35% payout ratio. It's pretty reasonable. Their use of cash flow, um, I mean, it's kind of all over the place. Really depends on the year, but they have been buying back, paying down debt since they went humongously into debt in 2019 for this acquisition. But again, it did increase their free cash flow quite a bit. So was it worth it? Maybe. Um, I think I'm ready to start making some assumptions here. On the revenue change side, it's a pretty big business. I'm not entirely sure the growth ahead of them. Pharmaceuticals is interesting. I mean, if you get a good bid, you could increase it a lot, but they're really so big that um, I'd almost say relatively flat, and they don't deserve any sort of premium. So flat business, 10p, 10 price to free cash flow. On the margin side here, 7%, 21%. I like that. Free cash flow is consistently higher. Owed a 2% increase due. So $30 billion, point 0.6. That's about 10% bump. $600 million interest expense bump is about 10% on their $6 billion 5 year free cash flow average. And so I'll bump it down a percent or so. So maybe let's do 7 and 18. Share change 0. On the cash flow side, I mean, they can afford it. They have a 30% payout ratio. So to me, I think they could easily afford to increase this, but it doesn't look like they've historically really increased that dividend per share. So maybe I'll just increase it 1% a year over the next 7 years, and we still get to a price that it needs to fall 58% to get a 15% return given these assumptions. I mean, it's a 4% yield right now, yeah, but doesn't look like the price appreciation is really going to be up for it. I mean, to me, I think these assumptions are fine. I mean, um, 10 on a P price free cash flow 7 years from now, to me, makes sense. It doesn't look like they have too much growth ahead of them. Yeah, they went up a bunch from 16 to 30, but we saw that that's because in 2019 they had a $26 billion acquisition to grow. And so, yeah, we do incorporate acquisitions into this revenue growth. I'm just assuming that they'll use their free cash flow for dividends and then paying down that debt to where um, their debt situation is definitely under control. They have nearly as much cash on hand as debt. It's what we want to see for a company. But yeah, I think I hope everyone has a great rest of their day.